Welcome back to Trading 360. We're watching Netflix. It's been exciting, and had a good first quarter, but the stock has been down almost $50. Let's find out what our panel thinks. Jamie Lumley, Senior Analyst at Third Bridge, and Kenneth Supp, Chief Strategy Officer at Nexen. Thank you so much for being with us. Jamie, I know that at least Bank of America thought it was a strong quarter, strong subscriber growth that they've seen, and think that one of the reasons that it's selling off is because they're only going to be giving milestones of the subscribers rather than all of the constant updates that people are used to. What say you about Netflix? Where does it stand, Jamie?
So heading into these earnings numbers, it's important to remember that expectations were incredibly high for Netflix. It came off of an incredibly strong end of 2023, a couple of really good performances in Q3 and Q4. So as we entered these earnings, there were definitely people were bracing for some very impressive numbers, and Netflix was still able to deliver on those expectations. Incredibly strong subscriber growth, getting in the high end of the range with revenue growth and delivering really strong operating results. If we think about that operating margin of 28%, it is head and shoulders above what all the other streamers, not even where they're at right now, but what their aspirations are for once these streaming businesses get profitable over at Disney or Warner, et cetera. So with all that in mind, there are still, though, some questions from investors wondering why now in terms of pulling back on the subscriber numbers and giving clarity there, and what exactly that means for the growth trajectory of Netflix's subscriber base.
You know, they don't have to anything, particularly when the competition is so fierce. Why let your competition know you've gained X number of subscribers or whatever? Ken, so tell me your thoughts on Netflix.
Yeah, what really caught my attention was their recent growth in the advertising space. It's something that they launched last year, and we saw significant growth quarter over quarter on those subscribing to the ad tiers, I believe 70% growth. And that is going to continue to grow. They did mention there's a bit of a gap on some of their products that they are offering in that space, but we do expect that will help them continue to grow that subscriber base. They believe that 40% now of all new subscribers are signing up for that ad tier option.
Yeah, I think that's that's definitely a highlight. Bank of America also had that in the note. The password sharing crackdown. Jamie Lumley, some more thoughts on some of the intricacies of this report. That's another part that's a win for the company, right?
Sure. So the password crackdown is definitely one area which could still be a growth driver for Netflix going forward. Back when they launched this initiative about a year ago, they were talking about how there were 100 million households sharing passwords. Based off the conversations we've had with our experts, we expect that ultimately 50% of those 100 million could be converted to Netflix accounts. And if we look at what the business did, adding high 20 million or so subscribers last year, there would still be room to run in that number before they reach that kind of terminal penetration rate of those households. And also to the ad tier, this is definitely an area to look at. It has slightly been below Netflix's expectations. If you remember, initially they were targeting 40 million monthly active users by the end of 2023, and they're approaching that number. Definitely strong quarter over quarter improvement, that 65% bump. And certainly with that, there's the opportunity further down the road to leverage potentially higher ad loads, really drive up those CPMs, and lean into the personalization piece to really get those targeted ads for Netflix's subscribers, which could ultimately make that a big business for Netflix. Of course, there's still a lot of questions about how quickly Netflix can scale from here. We're at the second round of upfronts for them, so definitely some interesting things to keep an eye on within the ad business.
Yeah. Look, I mean, there's so much competition in the space, right? And we think about Disney and Hulu and YouTube and Amazon Prime and Paramount. I mean, Paramount has moved higher because Apollo Global and Sony Group have been discussing a joint bid, reportedly, for Paramount. Spread it out here. Let's get this conversation a little wider, Ken. Where do you see some other winners or other names that are on your mind specifically?
Yeah, I think what we're seeing here is the Netflix password crackdown is going to be very beneficial for a number of other companies in that space. We know Disney has plans for that. We know Warner Brothers Discovery also has plans for that. And we do expect that those subscriber growth figures, which we know are so critical for those of us tracking those companies and their growth stats, will be higher, we do believe. And we also know that the ad tiers that playbook is continuing to spread across other streaming companies as well. So we do expect those numbers to continue to grow as people are really tightening the budget a bit on subscribers' subscription services this year.
Yeah. Jamie, final thought. I mean, I know everybody's cord cutting. I would never think of cord cutting myself. Final thought. You know, what's the win? For the win, which ones are the winners?
Well, I think one thing which is worth highlighting is as we move away from reporting subscriber numbers, operating margin will come increasingly in focus. And Netflix, with that in focus, can continue to flex its muscle. This is an area where it is really running up the score against the competition. Disney wants to break even in streaming this year. Paramount reached peak losses earlier than expected, but is still a ways away. Warner Brothers Discovery, depending on how you look at the reporting, is profitable, but still really trying to drive up the margins there as well. If we look around the landscape, this is the top focus of these businesses, away from subscriber growth to that operating margin expansion. And Netflix, even without the subscriber numbers, will continue to show just how much of a lead it has over these other businesses.
Yeah, it's about the dollars and cents, right? And those operating margins in focus, to your point. Netflix does well on that. Jamie Lumley, Senior Analyst at Third Bridge. Kenneth Suh, Chief Strategy Officer at Nexon. Thank you both very much.